but now let's go back and reconnect with Jahangir. Hopefully we have him on a better line now. Jahangir, back to you and that question on inflation. We were discussing first the expected US print and the fact that the market, at least I think, is geared up for one more rate hike, at least of 25 basis points. Your thoughts?
So we have the same view that, at the baseline is that there's at least one rate hike in the pipeline, which is the July one. But then, given the resilience of the US economy and the continued resilience of the labor market, let's see what happens tomorrow. But, if you get a 0.3, 0.4 core inflation print, that doesn't really put you into a comfort zone and rule out further rate hikes. And I'm using further rate hikes in the plural. So I think we have to wait and see. But, so far, the Fed has essentially delivered more rate hikes than the market had envisaged. And I think we might be in that state for some more months down the road. I think, on the inflation front, it is no longer that concern that we once had that, inflation was, at least core inflation was getting really, really sticky and, it could move up. I think there is much more comfort on that front. And I'm guessing one has to thank China for it because finally, the reopening normalization that one had been expecting a long time back is finally filtering through Chinese disinflation, through export prices. But I think that broadly, that's where I think things stand, that there is more comfort on the growth front, which obviously is not that great news for rate hikes, but there is at the same time more comfort that inflation may not, spike back up.
So that's on the US markets, right, Jahangir? What about back home? Because here inflation is shooting up, food prices, pulses prices have gone up quite a bit. And that has actually dampened hopes of a rate cut anytime soon. How are you feeling about what the rate trajectory could be from the RBI over the next 3 to 6 months?
So on the inflation front, clearly the food inflation is the problem, and then there are also concerns about, El Nino and others, which, I think those fears are probably exaggerated given the food stocks and food management. But I think India, too, is going to benefit from the disinflation that is coming out of China. I think we are underestimating that. So if you look at export prices coming out of China, which is essentially non-energy export, it is currently running at -7. Add to that the fact that the CNY INR has appreciated almost about 8-9%. And chances are that in the coming months, INR is going to appreciate further against CNY. And given the fact that China is our largest source of imports of non-energy imports, I think on the goods disinflation front, I think that disinflation will be imported. So whereas on one hand, 2 months back, we were all concerned about the stickiness of core. I think there is relief on the stickiness of core, but food inflation, it's anyone's guess, how things are going to pan out. But on the rate cut front, we have a rate cut. We have had the rate cut almost for 3 months now. The rate cut is in the fourth quarter, but it's not based on inflation falling off the cliff. It is actually based on growth slowing much more than what market consensus and possibly what RBI has.
All right. Hi, Mr. Aziz. Good to hear your thoughts. So what kind of growth estimates are you factoring in now for the coming year for the Indian economy?
So we're looking at about 5 to 5.5, but it's the first half, second half story. So I think the first half is going to be fine, right? And India, along with other emerging markets like China, has shown that resilience, and I think that resilience goes through into the first half of this fiscal year, which is the third quarter of the calendar. I think once third quarter gets past, I think there is significant amount of slowdown on the global economy. In fact, we need that slowdown to take place if, core inflation has to, globally at least, has to go to where, central banks' tolerance levels are. But if that slowdown does take place, I think, given the fact that India's growth over the last few quarters has been driven primarily by surprisingly strong goods and services exports, I think that's the driver that is going to get affected. And that's the reason why we expect in the second half of fiscal year growth slowing down in the 4.5 handle.
Okay. So, Jahangir, I guess, what you're saying is pretty much in sync with the report that I was reading yesterday about this divergence of central bank actions. I think it was from one of your peer banks, Nomura, if I remember correctly. And like you're saying, that you're expecting one more hike, at least in the US, and penciling in a cut maybe towards the fourth quarter, end of the current year here in India. And I think there's more anticipation that maybe China will cut a little more aggressively. There's a lot of anticipation on South Korea cutting. So if we do get into that zone where Asian central banks are cutting and the West is not yet done hiking, what does that typically mean for fund flows? I mean, when has this divergence played out in the past? And, where should we expect money to head in such a scenario then in the coming months?
I think the divergence has played out several times. If you recall, going back to when Janet Yellen started a rate hiking cycle post 2017-18, we had exactly the same divergence. So if you think about what's happened over the last 2 months, the two-year US has moved up 120 odd basis points. And the 10-year has moved up 75, 80 basis points. Emerging market has not even reacted to it. And whether it's capital flows you're talking about, or whether it's portfolio flows, I'm saying that whether it's debt flows or equity flows, emerging market flows just haven't reacted to it. Neither has emerging market pricing of rate cuts or of bond yields have reacted to it at all. And this is after 120 basis points of increase in the front end of the US curve. And I think the key remains what it was back then during Janet Yellen's rate hike cycle. And the key is, again, the same thing, is what happens to the dollar. Emerging markets do not move just because there's rate differential widening or narrowing, as the case may be. Emerging market capital flows moves if growth differentials narrow or widen, and what happens to the dollar. Because the dollar has remained so steady, I think you haven't seen the kind of negative impact one would have seen if you truly had, if the front end of the curve had moved about 120 odd basis points and the dollar had actually strengthened on the basis of it. And I think that's where I think everything rests. I think you can go through US hiking another 2 or even more rate hikes, and emerging markets cutting, whether it's Asia or Latin America, most likely in Latin America. But all of that is premised on whether or not the dollar holds at these levels, or even if it appreciates, it's a mild appreciation. If there is a disruptive appreciation of the dollar, then emerging markets get dropped.
All right, Jahangir, well, a lot of things are data dependent, right? But at least for now, we know that in the next meeting, the US will be hiking rates. So that seems to be the consensus view. So we'll take it at that. Thanks for joining us and speaking to CNBC TV18. Appreciate your thoughts. That is JP Morgan.